All right, ladies and gentlemen, welcome to Multnomah Group's Top Common 403B Problems and Solutions webinar. My name is Brian Montanez. I am a principal with the firm and a pension consultant here in Northern California. I have a specialty of working with 403B plans, in particular with education and with healthcare. I assume everybody by now is familiar with webinars and the ability to send questions via chat. I will accumulate the questions and try to address them at the end of the hour. So I'm going to go ahead and start. The agenda today is to provide a brief overview of the IRS correction programs, also a brief overview of the Department of Labor correction programs. And Multnomah Group has actually done an extensive webinar on these two correction programs that you can find on our website if you want more information than what I'm going to provide today. I'm also going to talk about the common document issues that we see with 403B, common governance issues that we see with 403B plans, and common compliance errors and failures. And in all scenarios where I identify an issue, I will try to identify either the best practice or the correction that should be associated with that. And my goal today is to provide a practical approach to these issues. As a consultant, I regularly roll up my sleeves and dig into clients' issues. I'm not going to get too legally technical, but I'll try to keep it practical and talk to you about what I'm really finding and really seeing out there in the world. So, correction programs. So the IRS has a correction program called the Employee Plan Compliance Resolution System. I refer to it as EPCRS. There's a couple general correction principles before you can use EPCRS to go ahead and correct your issue. First, you have to have the internal controls to prevent recurrences of whatever issue it was that you had. Second, you have to have a reasonable and appropriate IRS-defined correction, and they do a very, very good job of defining what the issue were and what the resolutions can be on their website. And third, whatever the issue is, you have to be able to restore and make the participants whole as if the issue had never occurred. Under EPCRS, there are generally 4 types of qualification errors. First one is very common, and it's a plan document failure. A plan provision or absence thereof that on its face violates the requirements of Section 403B, and I'm going to talk more about that extensively. The second common problem is an operational failure. This is by far the most prevalent failure that we find, and it is solely from the failure to follow the plan document. Issues are that people don't understand what the language of the document is trying to say. That's where we find most issues, is actually following the plan document. The qualification failure, demographic failures, failure to satisfy basically nondiscrimination requirements or coverage requirements, that ends up being an operational failure. And 4, employee eligibility failure, where the employer is not eligible to sponsor the type of retirement plan that it's using. So EPCRS has 3 different programs that they offer. First one is my favorite, self-correction program. Very simply, it's an honor program, and it's limited to operational failures, so basically not following the plan document. And it is limited to insignificant problems or significant if the issues are addressed within 2 years of the plan end. Issue was uncovered. Actually, where the issue was incurred. Now, here I like it. There's no notification and no fees required. So basically, go through, correct it, document the procedure that you went through and the correction that you went through, and you should be okay. Second program is the Voluntary Correction Program, VCP. This is for plan qualification failures, and they're not eligible for self-correction, so it's that catch-all. Or, simply, when you want the IRS's assurance about the methods you use to fix the error. So in the correction program, you're on your honor to fix it. In the CP program, you do go through and fix it, and you submit a fee, and you submit the procedures that you did, and you ask the IRS to do an approval of the corrections that you make. You must make a written submission and pay a compliance fee. The compliance fee is based on eligible participants in the plan. so it could be substantial if you have a large plan. Errors are corrected and a plan status preserved with the IRS help and approval, and you have a documented letter back from the IRS that states such. The IRS program is something called the Audit Closing Agreement Program, or Audit Cap. And this always makes me chuckle. The Audit Cap permits you to correct errors and preserve the tax benefits for plan participants and sponsors. If you wouldn't do that when auditors were there auditing you already. There's a fee to the IRS, and it will be greater than the fee required under VCP. So if you get caught and the audit catch you, charge you more than what you could have done on your own voluntary basis through VCP. But if you go through the audit cap program, it will be less than the maximum penalty that they could have charged you. Next, the Department of Labor. So the Employee Benefit Security Administration has a couple programs as well. They have the Delinquent Filer Voluntary Compliance Program. So if you had missed a 5500 or had problems with the 5500, you can go through the DFVCP, and it assists with late or missing filed Form 5500s and coming up to date with corrected filings. Occasionally, you do find a static error that had been going back for years, or maybe you had it, you didn't say that you were auditable in prior years, or in some cases where I've actually found plans that did not realize they were subject to ERISA have to go back and file all those past 5500s, or plans that didn't realize that they were auditable have to now go back and correct their 5500s with their audit report. This has the Voluntary Fiduciary Correction Program. This affords plan sponsors and officials a chance to correct any of a specific 19 transactions. In the fourth bullet, I actually give you the URL to go find those. The VFCP also provides immediate relief from payment of excise taxes under class exemption, which covers 6 specific transactions. Violations can be fully and correctly resolved in 4 easy steps. Wink, wink, nod, nod. If you have the appropriate representation, 4 easy steps. And for a list of those violations and corrective actions, you can do that URL. Now, many of these corrections that they list aren't real common, but where you're going to use the VFCP is unfortunately very, very common, and that is for those late deferrals. So if the auditor or the audit or your own internal review finds that you have been making salary deferral contributions late, and late is any time frame beyond basically the fastest you've ever done it. So if you average, if you in the past have done it in 4 days, and you now have a new high watermark of 4 days, you now have to make those salary deferral contributions in 4 days. And if you have not been doing that, the VFCP allows you to go ahead and correct that by paying a small fee. So, digging into what our clients and partners find, common plan document issues. So I'm going to talk a little bit about common document issues and their resolutions. But not what we're still seeing out there as a common issue is no plan document. We still run into vendors. We still run into plan sponsors, particularly on the smaller side, that still don't have a plan document, or didn't realize and didn't get their stuff done in 2009, so they're adopting it in 2010, 2011, 2012. So there'll be a late adoption program. So there is correction for that. First, what we do is locate and review any and all types of plan documents, contracts, service agreements, whatever you can find that might have a benefit right or feature described on it, even the board resolution or board minutes that might talk about what the benefit rights and features of your 403B should be. If you can't find the document or find the amendment, call the vendor. I would say they should have it, but practically speaking, only in the last couple of years have vendors started to require, especially with 403Bs, have vendors started to require written plan documents. They used to just work off of whatever the plan document was supposed to be, or whatever the plan sponsor told them to be. But the last couple of years, they've started requiring signed plan documents. So if you can't find if you can't find an amendment, or you can't find your document, call your vendor. So if you can submit under VCP the applicable compliance fee and get absolution. The IRS has done a nice job here in the sense that they created a submission kit specifically intended for 403B plan sponsors that missed the 2009 deadline. And you can do the Google for the IRS VCP submission kit, and you'll find one for 403Bs. It's straightforward and fairly comprehensive. If the failure to timely adopt the written plan was the only failure, and this is made by December 31, 2013, and that there is proof that they're still seeing it, they're still offering a 50% discount for common document issues all the way out to 2013. Keep in mind, these regs were effective January 1 of 2009. That often this is still happening out there. We'll give you a reduction of 50% for the compliance fees if you do it by the end of this year. Common plan documents, missing amendments. So there's a couple types of missing amendments. One is legally required, so heart or wearer that happened a couple of years ago. It may or may not be legally required. Not discretionary about it. It was adopting new regulations. And then the voluntary or discretionary. So maybe you wanted to add an employer match or change the employer match, or you wanted to offer hardship distributions or take them away. You didn't actually sign the plan amendment. Maybe you even have the plan amendment in hand, but it was never actually executed. So there is a correction program for that. Now, the correction may be to correct a failure by making a submission under VCP and paying the applicable fee. You should consider retroactive amendments to expand benefits. So, where you found that you had hardship distributions, you were allowing hardship distributions to your participants, but the plan document didn't actually say you were allowed hardships, you can go back and amend the plan document to expand that benefit to bring your plan in compliance with the actions. You also might consider doing that if you failed discrimination testing to retroactively expand the benefit you're offering your staff so that you can pass that discrimination testing. Same thing with something like loans or especially 403Bs with the universal eligibility rule. If you offered the 403B plan to a group of employees or an employee that was in an excluded group, correct that by going back and expanding the plan document to offer the benefit to all those employees in that one excluded group. Again, see the IRS submission kit specifically intended for 403B plan sponsors that missed the deadline. Again, it does a pretty good job of explaining what you should do. More common plan document issues. ERISA, non-ERISA. Still these arguments with different proposals and different plan sponsors as well. Many plan sponsors are still claiming to be a non-ERISA plan. A couple issues here that we find that make it clearly ERISA. If you have 401A or a profit sharing plan whose match is based on 403B participation, you are clearly ERISA. To be exempt from ERISA, there's some clarity, such as statutorily speaking, churches are subject to ERISA and governments are not subject to ERISA. So a church plan or have a governmental plan, you're not subject to ERISA. To be exempt can be defined by the designation or by the practice. So if you have voluntary participation and the plan assets are solely enforceable by the participant and you have limited employer involvement, meaning you're basically just remitting contributions, and the employer receives no contribution and you have no more than one vendor, you can claim non-ERISA. However, the limited employer involvement and the more than one 403B contractor, those are the common issues that we find. And we'll have a 403B plan that says they're non-ERISA, yet are approving loans or they are approving hardships. Well, that's employer involvement, and that's not limited. If you are approving loans and hardships and stuff like that, you are now ERISA. And more than one 403B contractor. So it's a pretty firm rule, but not an absolute rule. So if you are a large employer or a mid-sized employer and you're offering more than one 403B vendor able to claim non-ERISA. But here's the problem. If you only have one vendor and you're a mid or large size company, you're going to be able to claim ERISA because the rule says you have to have more than one vendor to be ERISA, with one exception of if it is burdensome for your organization. So think a 3-person nonprofit, a 5 or a 10-person nonprofit. If it is burdensome or cost prohibitive for you to offer only one vendor, then you can offer one vendor and still try to claim non-ERISA. But it has to be to you to offer more than one. These conditions we're still seeing out there today. So the DOL put out a field assistance bulletin 2007-2 that defines basically what I just explained. If what I said to you was a little confusing, either give me a call or Google the 2007-2 field assistance bulletin and read it. It's fairly well defined. And if that's still a little bit confusing, find counsel, get a little bit of help with that definition. There's also another field assistance bulletin that defines the exemption description, so further defines the descriptions that I just went through, and that's Field Assistance Bulletin 2010-01. And prior Form 5500 filings, you can go through the DOL's DCP. If you figure out that you are now subject to ERISA, well, the question is, have I been filing my 5500s? And you probably haven't if you thought you were non-ERISA, so you will have to go back in time and file those 5500s. Plan document issues, multiple 403B plans. This is something we, again, regularly see with nonprofit groups. They have 3 or 4 vendors because they're basically legacy vendors. They've been around forever. So have more than one 403B vendor? If so, are they ERISA? Are they not ERISA? Is it worth the extra administration, the extra communications that you're going to have to go through, extra confusion for participants? There's a lot of issues that come up with operating multiple 403B plans that create issues, such as what I've said here. So what we as a best practice is stop and review the benefit, rights, and features of your multiple plans. Vendors, folks, not multiple vendors, multiple actual legal plans. Review testing that you've been doing because you're a control group and you're going to have to test all the different benefit, rights, and features together. Review the investment structure. So what do I review the investment structure? We've seen where people have taken 2 or 3 403B plans and consolidated them down to one, and the same mutual fund with different classes. That would actually be a fiduciary violation if you were offering the same exact money market fund paying 0.2 with a 0.2% expense ratio, and the exact money market fund in one of the other plans that you merged and it has a 0.5 expense ratio. The same product with 2 different fee structures, that could be an issue. But review the benefit, rights, and features, review your testing, review your investment structures, and then consider consolidating plans. It'll make life so much easier on your administration side, on your patient side, and for your employees, and eliminate having to manage 3 or 4 different documents. Common document issues, missing or outdated beneficiary designations. So it is not legally required to have a beneficiary designation, but it is absolutely a best practice. And what we know is that participants fail to designate or update their designations to reflect their life events. Especially with the repeal of DOMA a few months ago, now there's an entire new class of people throughout the country that are legally considered spouses. And with assets, if you're going to assign the rights to a third party, say I want to give my retirement assets to my brother, well, I need spousal consent to do that. So after DOMA, there's a whole new class of employees out there that are now legally married. They need to go back and check their beneficiary designations to see if they're in good order, because their spouse would have to sign off on it if they're trying to give their money somewhere else. People get married and or they get divorced. This changes, again, who spouses and who legally can get the money or has rights to those monies. So we absolutely encourage people to back and review your beneficiary designations. Now, a couple of challenges. So even if we have it, all our intentions are right. A couple of other challenges we see are when we have multiple vendors in an individual plan. Each vendor is going to have their own beneficiary designation form. So you could have a problem where you have two different beneficiary designation forms for each of the different vendors. We also see, and by now I'm going to assume that most people on this webinar here today know the difference between individual contracts and a group sets. So what we've seen is when we have individual contracts that is, often the beneficiary designation will apply only to those contracts. But then you may have moved to a group contract or done a vendor search and changed your vendors, and that vendor had a plan-level beneficiary designation. So that plan-level beneficiary designation is going to conflict with that individual contract beneficiary designation. So now you've got a fight as to which beneficiary designation is in force. So I absolutely encourage you to go back and review whose beneficiary designations are in force. And who's coordinating those distributions? So we have two different beneficiary designations, and someone makes a claim on those assets. Is vendor A going to automatically distribute those, or are they going to come back and talk to you to see what vendor B is saying about the beneficiary designation? So you want to go back and try to figure out who is in charge of coordinating the compliance aspect of the beneficiary designation. Best practice, default beneficiaries in the plan document. Yeah, the document can actually put the hierarchy and say spouses, the first people, obviously, so that if there are any questions about the beneficiary designation 10 years from now, or with the new vendor or with an old vendor, you go back to your plan document and say, oh, we have an existing beneficiary designation. You can change it, but there's a default beneficiary designation for the people who have not filled out a beneficiary designation. Conduct an annual education program for a reminder. Especially here in November and December, as we're looking at open enrollments for the new years. This is a great time to do a reminder. Just one slide in that presentation that you're going to make that says, have you updated your beneficiary designation? Just remind people that it needs to happen. And Multnomah Group has put out a white paper, Best Practices for Beneficiary Designation in our Retirement Plans. And it's available on our website and further explains much of what I've just said here. For the document issues, if you have questions on document issues, by all means, please send me a chat, and we'll try to address them at the end of the call. Let's move on to common compliance errors or failures. So number one, number two, and number three, this is the biggest issue we see out there on a regular basis, and it's so big I actually gave it two different slides. So what's the definition of compensation? First slide, I'm going to talk about testing that definition. The second slide is understanding and comprehension. So now about half the audience is saying, uh-oh, definition of compensation. So a couple different concepts here. So whose compensation is actively being excluded? So when we start with the definition of compensation, by definition, it's what is compensation and what is not compensation. And what we see commonly is that people will exclude bonuses or overtime. Common issues. However, whose compensation are you taking away? Is it a highly compensated person or a non-highly compensated person? I encourage you to go back and look at who is getting bonuses versus who is getting overtime. Generally speaking, when you exclude overtime, you are taking definition of compensation away from non-highly compensated people. Reduce the amount of compensation that those non-highly compensated people have. You could have a 414S definition of compensation testing problem, and that cause all other types of operations of compliance failures within your non-discrimination tests. Generally speaking, excluding bonuses takes money from highly compensated. Okay to reduce the definition of compensation for highly compensated people. They don't mind. The Department of Labor doesn't mind that. When you start to reduce what compensation for non-highlies, that the Department of Labor says, hold on a second, cannot reduce that too much, because effectively you're taking away employer contributions from them. If he gets 5%, and the non-compensated have a smaller definition of compensation, they're getting a lower amount of employer contributions. Definition of 414S testing, so you have to test every year. If you're excluding anything from compensation, you have to go through and test that definition to make sure you are not discriminating against the non-highly compensated. Loosely, you have a difference of any more than 3%. So basically, the highly compensated, the total compensation that is included for retirement plan purposes for highly compensated cannot be more than 3% higher than the total amount of compensation included for retirement plan purposes for the non-highly compensated. So other compliance issues with the definition of compensation. Post-severance compensation. This comes up a lot when we start talking about key executives leaving. I find that very, very few people who work with retirement plans understand what post-severance compensation is. So let's start with what is post-severance. Well, termination date. Anything after your termination date is post-severance. So you are going to put somebody's termination date out 6 months and to continue paying them now, even though they're not working. That's fine because they're still employed. They're not post-terminated. So what is post-termination compensation? Post-termination compensation is compensation paid after termination date. So sick leave, and here in California, accrued vacation paid outs, personal time off, that sort of compensation. So that final paycheck, the one that may come a week or 2 or 3 after the termination date, that money can, if plan document says so, be included in compensation, and I can still defer my money, my salary deferrals on that compensation, and receive my employer contributions on that post-severance compensation. These are elections. They're not required. Depending on what your plan document says, you may be able to defer on that final paycheck and receive an employer contribution on that final paycheck, but it is up to you in your plan document. I encourage you to go back and take a look at what your plan document says. These types of compensations can be any of these compensations that are paid within 2.5 months of termination date or within the end of the computation period plan year. Think 2.5 months because it would be really odd for compensation to be paid beyond 2.5 months. And the IRS does a pretty good job of explaining exactly what post-severance compensation is. If you wanted to do that, Google. What is severance? So severance is that compensation that you have negotiated with a participant will be paid as a severance package at the termination date. So this is very clear that if it is post-severance, then it's a severance package. Severance packages cannot be considered compensation for retirement plan purposes. So versus post-severance. Severance is that severance package that you negotiate with someone. Post-severance is that final paycheck, that sick pay, PTO, accrued vacation time. I encourage you to go back and look at your plan documents and make sure you understand what's happening there. And then with 403Bs, we have a very unique provision, the 5-year post-severance provision. That provision allows a participant to receive employer contributions on their compensation for up to 5 years after employment. They are not allowed to defer money on that compensation. They're only allowed to receive employer contributions if the employer has put that feature into the plan document. This gets used especially with tenured teachers who are maybe being paid substantially more than would paid to a newer teacher. Someone there forever, has the same job, has a very high salary, and management would like that person to move on. The negotiation tactics would be, we'll give you up to the 415 limits, so $51,000 in 2013. We'll give up to that limit for the next 5 years for you to go away. That's the deal, $250-something thousand for 5 years to retire a little bit early. Works out pretty well. So when we have these errors, when we have these failures, corrections. So my suggestion because there are a lot of moving parts in the benefits office, a definition of compensation to a safe harbor definition or something much, much more reasonable. Make it easy to understand, easy to communicate, and easy to test, and then you won't have that issue. The reality is the amount of money that is saved from employee contributions by skinnying down the definition of compensation probably isn't worth the effort it goes to administer that. But that case-to-case basis, I encourage you to go back and review it. Also, if you did have a problem with this, maybe you forgot overtime or bonuses were excluded, maybe you excluded too much compensation, or maybe you used the wrong definition of post-severance compensation, there are corrections. And you will have to restore a participant's benefit depending on which way that error went. So again, go back to the Department of Labor's programs. Definition of compensation continued in the sense of errors and failures. So, fail to administer the plan to the actual definition of compensation. We just got the different ways that the definition of compensation can be changed, and I know that was fairly confusing. But about it from the administrator's staff perspective, which is somebody looked at the definition of compensation last year or has a preconceived conception of what the definition of compensation is, and they aren't actually administering your plan according to the legal definition. So what happens? Well, actual deferrals not match the participant's instructions. They said defer 5% of compensation, and when you look at what compensation is, you get it wrong. You're actually not putting away how much they said you should put. Sure, your non-elective contributions are going to be wrong because you have the wrong definition of compensation. Incorrect non-discrimination testing, again, because you have the wrong definition of compensation. You could be exceeding both 402 and 415 limits. 402 is the individual limit, where I want to put $17,500 away this year. If you have a wrong definition of compensation, I could actually have deferred more money and have a tax consequence. Or you, as an employer, could actually exceed both salary deferral and employer contribution, that maximum limit of 415, and have limitation issues there. And your determination of the highly compensated employee be wrong, and that would cause with all aspects of non-discrimination testing, because non-discrimination testing is based on HCE versus non-HCE. So, best practice: go ahead and understand all that is included in your definition of compensation. If something that you don't quite get, make sure you understand it. Don't just pass up on it. Because severance to post-severance, there's a big difference between what they are and what is and isn't allowed. Simple the definition, cost value. What is the effort that it takes to administer that different definition, and what value are you getting from it? It might just be easier to say, fine, let's leave that in the definition of compensation, because in the end it only costs us a certain dollar amount for our employer contributions. Restore participants to a place as if no error happened. So yeah, you may actually have to fork over some salary deferrals and the correction on those earnings. And correction programs may be used to correct insignificant operational problems. See RevProc 2018-12 for the definition of what is insignificant. The difference between insignificant and significant is either voluntary self-correction program at no cost, or you're going to need to hire someone to take you through the self-correction program is a no cost, or you're going to need to hire someone to take you through the VCP program, which does have penalties and fees, and you're going to have to pay for someone to take you through that process. So take a look at what the definition of insignificant is, because if you can make it insignificant, that'll save a lot of effort. Other common compliance errors and failures: excess contributions. So two concepts. One is, what is the total compensation that can be used? If somebody makes $400,000 and they say defer 5%, you're not deferring 5% of $400,000. Compensation in the qualified plan world stops at $255,000 for 2013. So making over $255,000, you cannot include any of those dollars above $255,000 for the qualified purposes. So if your employer match is X percent, it's only X percent of 255, not X percent of the 400,000, and they are still limited to that $51,000 overall limit. So make sure you understand who's making above 255 and that the compensation you're using for salary deferrals and employer contributions is only up to 255. We also see salary deferral limits. So 402G is the rule that says, hey, I can defer $17,500 for myself this year. We see this when we have employers doing their own internal payroll. If they're relying on a record keeper to notify them when their participant has reached the max. Well, one of the issues with salary deferrals with the record keepers doing it is they tend to be doing it on a cash basis. So they receive the money, then they add it up. But someone defers it, a couple of days later you remit to the record keeper. The record keeper can be an entire deferral contribution away, which means you end up exceeding the limits by an entire deferral contribution, especially with that December payroll. The two other types of definitions of limits. So if you're over 50, a participant can defer another $5,500. That's easy. Most people get that one. And the problem child. 4Bs have a unique feature for deferral limits. This is not in 457s and 401ks. The 15-year. So rich people saying, yeah, we have the 15-year catch-up. There's a couple problems with the 15-year catch-up that I'm actually going to talk about in a little bit. But for this purposes, keep in mind that that 15-year catch-up is included in the salary deferral, in the total contribution limits. So $51,000 for this year. If someone has the 15-year catch-up, that money, just say they put $3,000 in there, that money goes against the $51,000. It is not on top of the overall limits. Common errors and failures, excess employer contributions. We do see that again coming out of having used the wrong definition of compensation and or not limiting compensation to $255,000. So corrections best practices. At the end of the year, kind of now, November, December, we recommend to review the limits prior to each year. It's a great opportunity now to go look at who might be coming up on 17.5, and that, of course, is probably going to be a senior or key employee, and just make sure that they understand they're limited to 17.5. If you exceed it, you do need to refund it and 1099 it. You do need to do it within 2.5 months after the plan year end, or you will have a 10% penalty. If you now go back and find these issues and you look back and there are multiple years, you can go back and correct them through self-correction program or VCP, depending on if they're significant or not. Common errors and failures, eligibility. So, in 3B world, we have this unique feature, not present in 401ks and 457s, universal availability. So universal availability says that you have to offer your 403B plan to all employees. If employee of the employer is eligible to make elective deferrals, all employees must be eligible. However, they do have 5 permitted exclusions. So if you make one of these 5 permitted exclusions, then you have to exclude all the people in that class. One is employees who will contribute $200 or less in the entire year. Number 2 is employees who participate in the 401k or 457B or another 403B of your employer. So if you have multiple plans, you don't have to allow everybody into the same plan. Non-resident aliens, students who are performing services, and this is the slightly trickier one, employees who normally work less than 20 hours a week. Here's the problem with the employees who normally work less than 20 hours a week. You have to be able to track those hours. And if you can't track hours accurately, I do not recommend that you use that exclusion, because when you allow those people in, you have to allow the entire class of employee in, and now you have to consider the cost for the match or the cost for the employer contribution, because you had intended to exclude them, but now they're in the plan. So eligibility issues, rehabs. See a big issue with rehabs. The first one is called break-in service. There's break-in service for eligibility, and there's break-in service for the definition of service for years of service. A break service, and it's usually defined that way in your plan document, basically says this. If an employee left employment for a specific number of years and not been credited with a specific number of hours, you can make them re-qualify for eligibility. So if it's 5 1-year breaks, so they've been gone for 5 consecutive full years, you can actually start them over for an eligibility purpose. Now, the other step is when you have people that come and go regularly, and I actually have a couple of clients where people come for 3-month stints and then they go for 3 months and they come back for 3 months. So eligibility break in service, which will be defined in the document, usually goes like this. If an employee is not credited with 500 hours in that term of employment, you don't have to count those hours for service. So if sometimes it works 350 hours, then they take 3 months off, and then they come back in and they're 350 hours again, well, you count the first 350 hours because you had an eligibility break in service. So you start counting when they come back, and you don't have to give them credit for the time worked until they have worked that 500 hours. So with rehires, we also see problems with automatic enrollment. Are they a new employee or are they not? Is automatic enrollment only for new hires, or is it for everybody who is not deferring? Depends how your automatic enrollment was designed, because for everyone who's not deferring and someone rehire, well, then they need to be put back in the plan. If a new employees only, is this person considered a new hire or not? Or simply, please make sure that your record keeper is tracking who rehires are. We had a recent case where we found that a record keeper was not tracking rehires and therefore were not automatically enrolling people that rehired. We had to go back for 3 years and make a correction and a significant financial contribution to the participants' accounts because that's what the correction was. So I encourage you to go back and look at what breaks in services are and how you handle rehires for automatic enrollment. That the vendor or benefit office is tracking rehires. Start there. Make sure you're absolutely tracking rehires when they come and go. Potentially retroactive entry dates, employer and salary deferrals. So if you do have that problem, you may have to go back, as I explained with my one client, and say, okay, well, this person was supposed to have been enrolled as of January 2012, and your correction for that is to make a contribution for their salary deferral lost opportunity, and you have to adjust that for earnings, and you have to give them the full match that they would have earned. So it can get very expensive if you're not tracking those rehires. And restore that depending on if it's a handful of people or if it's a large percentage of people, either via self-correction program at no fee or the voluntary correction program at a nominal fee, but then you do get the letter approval. So yes, breaks in hires and automatic enrollment pay special attention to them because they're sort of obscure concepts. Now, as I had threatened, the 15-year special catch-up provision. It is a challenge. So first, availability. Do you have data on a person that's working at your organization for 15 years? We've actually found that not the share, but most cannot show data for 15 years. So can you prove that they are eligible for the 15-year special catch-up? Human resources and participants' understanding of the rule. We find many people don't actually understand the rule. Loosely, what the rule is if you have been with an employer for 15 years and have not maximized your contribution in each of the years, you can qualify for a special 15-year catch-up. The rule is basically you can put another $3,000 on top of the age 50, on top of your 402G limits, but really show 15 years worth of data that shows that they did not maximize their contribution. And more thing is, if someone over 50, and for the over 50 catch-up, and they have the 15-year special catch-up, but can't maximize both of those, which one's first? So if in an extra $2,000 above and beyond my individual limits, does it go against the 15-year catch-up provision, or does it go against the over 50 catch-up provision? Most people that I've talked to don't understand that. The rule is it goes against the 15-year catch-up provision first, then the age 50 catch-up provision. So we found that participants don't understand the 15-year rule. Benefits don't understand the 15-year rule. It is very confusing to try to do the calculation to see how much somebody can defer in the 15-year rule. So most clients that we end up working with say they just take the provision out. So what could you do if you had a failure with the 15-year rule? Well, you're able to recharacterize the contribution as an over 50. You might have to refund and report that contribution on 1099-R. You would have to go through the self-correction program if it's insignificant, or the voluntary correction program if it is significant. So the confusion with issuing this and the confusion with communicating this, we usually recommend to folks to take the 15-year provision out. Compliance, errors, and failures, notice delivery. So yes, we have the SAR, the Summary Annual Report, the Summary Prescription, the Summary Material Modification, 404A Participant Notices, Universal Availability Notice, Qualified Default Investment Alternative Notice, Automatic Contribution Arrangement Notice. These are all notices that have to be sent to participants on an annual basis. Well, not annual. The SPD or the SMM are there if you make a change in your plan document. But the rest of them are annual. So you have a way tracking who, when these documents are being sent. Start with who is responsible. Is it in your office that responsibility for making sure this stuff is getting done? And the fulfillment of these disclosure notices is actually documented. Is it your record keeper? We'll find that often with record keepers and TPAs, the mailings are happening to former employees who do not have email addresses. So you can satisfy these requirements by sending an email if the participant has used authorization or if they have a work email. But for former employees, we don't see many that keep up with the email, and we don't see many TPAs or record keepers that say, sure, we'll go ahead and do the paper mailing. What we say is we'll email to people that we have emails for, and we'll give you the file for you to print and mail to your staff. So who's responsible? Is it TPA, the record keeper, your staff? Is it a committee? And then what is the delivery method? Are you sending emails to all those that you have emails? Are you sending paper? Are you sending paper to all? Because if they don't have a work email or haven't given you approval to send them electronic communications, then you actually have to send them paper. So best practice is to outsource the delivery. We see many HR offices that really want to get in the business of licking envelopes and stamps and sending them. But once a year, go back and document internally that those notices were actually sent out and when they were sent out. And assign a responsible internal party the document delivery. Maybe it's finance, maybe it's a controller, maybe it's benefits, but assign responsibility to someone so that they are clear that they have the responsibility to make sure that all these different notices are sent out. And yes, you can consolidate some of them, but based on the timing requirements, you'll likely have to do multiple mailings in a year. So it gets a little bit challenging. Assign responsibility to someone specific. And a big one for errors and failures, late deposits of employee deferrals. So what is considered late? Well, different rules. So small plans, long plans, 7 days, 15 days, or something else. Well, the Department of Labor has been very clear in saying that the fastest you've ever made your salary deferrals is your benchmark. So for all plans, you've heard people say, oh, they have until 15 days after the month of the deferral. No, that's the maximum you can go without getting into trouble. If you've ever done it faster than 15 days after the month, that is your new benchmark. You need to make deferrals by that time. For plans that give you that safe harbor of, up to 7 business days after the day of deferral. No, again, that's the farthest you can go out. If you've done 4 or 3 or 2, that's your new benchmark. You need to make sure that deferrals are remitted in that time frame. So this one isn't so easy to correct. You do have to make the deposit plus an earnings adjustment. So if you've been holding on to the salary deferrals more than fast as you've ever done them, you're receiving a benefit, and that's a fiduciary violation, which is why you have to go under the Department's voluntary fiduciary correction program. And if that's the one that does have application fees, does have penalties, and will likely require professional assistance to process that. So, summary, what's your fastest remittance of salary deferrals? That is your benchmark. I encourage you to adhere to that benchmark. This one the Department of Labor will come down on you for. Other compliance issues, so QDIA. So what is QDIA? QDIA is a qualified default investment alternative. QDIA, the Department of Labor has defined in that DOL-FAB 2008-3 what a QDIA is. It can be, initially speaking, it is an investment that has an appropriate mix of assets from cash and bonds and stocks. Simply, Department of Labor does a good job of saying basically it's a balanced fund or a target date fund or a managed account. If you follow the QDIA rules, and when a participant does not give you investment direction, so they don't fill out a form and tells you what to do with the money, and most commonly you have an employer contribution to make on their behalf, where do you put it? Well, you follow the QDIA guidance given by the Department of Labor, because if you do what the Department of Labor says, you're not liable for those investment returns. If you individually pick an investment or put in market so that it's the safest, more liquid asset, that's actually not what the Department of Labor says, and you will be responsible for the investment returns for that individual participant. So sponsors default into investing mistakes. We see people regularly put them into a non-QDIA, thinking that the money market is a good one. The Department explicitly says in the Field Assistance Bulletin, you cannot leave money in a money market. I personally have also seen where clients have said, okay, we are holding it on the accounts of the books of the corporation, and we get an investment election where they literally keep it on books, and they're accumulating $5,000, $10,000, $15,000. I've actually seen one client where they held on to assets for multiple years for a particular person who had not given investment elections. That's a fiduciary breach. Best practices, that's a DOL-approved QDI choice. So either an investment policy statement, in your plan document, in your minutes, somewhere, put down what the was to use as a QDIA. If an issue, you do have to make the participant whole under VCP. So if you did put them in the money market fund for 3 years and the stock market's been up 35% over the last 3 years, guess what? You owe them the 35%. Yeah. And unfortunately, because it is a fiduciary issue, you do have to go through the voluntary fiduciary correction program. I encourage you to go back and read the DOL-FAB 2008-3, talk to your vendor, talk to your consultant, because this is a very easy choice on what to do with participants' money. So another issue that we're finding, termination dates. So participants with legacy vendors or vendor situations, we're finding that benefits are not actually keeping up termination dates with those employees. And this is significant because many distributions are based on a participant's termination date. And required minimum distributions are based on employment status. So you need to ensure that all those legacy vendors are getting termination dates from you. And I apologize, I'm going to speed up a little bit as time is moving on. Correct. Develop a practice for notifying all vendors at the same time of an employee's termination, and perform an annual audit of termination dates. Vendors can work with you. It's a simple report they can send you, but make sure you have the right information out there. Other governance issues. So with governance issues, we see quadro administration. Often we'll see someone in the back office of the employer approving a quadro. Well, it's a legal document. Being a non-legal resources doesn't say a good mix. The quadro legally must contain very specific information, and the quadro may not require some of the common distributions. So we say outsource it to the records keeper if available and if it's cost effective, because they do have the legal resources for this, or establish a relationship with a legal resource local to where you might be. Common governance issues, lack of plan oversight. We really see compliance obligations. Who's responsible for the insurance compliance obligations? What obligations? Who is responsible and how are they ensuring prudence? What we're saying is create a board-related retirement plan administrative committee, advisory committee, whatever it might be. Because absent a written delegation of roles and responsibilities, this responsibility does sit with the board. If the board not executing on those fiduciary responsibilities, then nobody really is. Create a charter that says from the board to you and your staff who will have what responsibility for compliance and who will have what responsibility for fiduciary obligations. So create a charter, create an investment policy statement, perhaps a fee policy statement. Absolutely keep minutes because, as the DOL says, if it's not in writing, it didn't happen. And document everything that you are doing. Governance issues, lack of fee benchmarking. So saying that you have a claim of excessive fees, but not doing fee benchmarking is fairly good evidence that there's no fiduciary oversight of fees. How can you prove proof of fees if you don't benchmark them? Understand all the details of your 408B2 notice. Didn't understand it. And benchmark plan fees, we suggest doing it annually. Per head pricing, hire a independent professional to help you if you need to. Lack of internal controls. Anyone who touches the plan or its operations could commit administrative or fiduciary violation. Processing, benefits communications, distribution processing, disclosure delivery, investment decisions, requirement filings. Who has responsibility for all of these pieces? And is there internal control to make sure that it's happening correctly? Read and understand your plan auditor's management letter. It's not a compliance review, but it's a pretty good place to start when your plan auditor finds problems with the way you're running the plan from an internal perspective. They will document it as observations. And create a checklist of administrative and fiduciary obligations that you're going to have to deal with every year and put on someone's desk and run through it month by month. To learn about this stuff, do a quick Google search for the IRS EPCRS program. Do a quick Google for the Fix-It Guide, the 403B checklist, the Delinquent Filer Voluntary Compliance Program, and the Voluntary Fiduciary Correction Program. There's a ton of resources out there that very well defines, most likely, your issue and the appropriate correction. Now, see if there are any questions. I don't see any questions. If any come through after we hang up, I will respond in writing to you. Thank you for your time, folks. Have a nice day.